Okay, welcome to the Armchair Trader podcast. This week we're talking about the insurance sector, and we actually have the CEO of a listed reinsurance business on the podcast today. We're welcoming Trevor Carvey, who's CEO of London listed Conduit, to the podcast. Thanks for coming on today, Trevor.
Thanks very much. Yes, looking forward to having a conversation.
Just for starters, can you just give us a brief overview of what Conduit is as a company?
Yeah, sure. And I'm certainly aware that reinsurance, which is our business that we transact, is never the most visible business, if you like, to the general public. So, just as a way of describing it, most people are familiar with insurance, obviously, and insurance policies are bought from insurance companies. So if you're insuring your house or your car, your boat or any other asset, then it's bought from an insurance company. As a reinsurance company, which is what Conduit is, we have as customers those insurance companies. So essentially, when those insurance companies, in building their portfolios, get to a situation where either their capital is being more stressed or they have certain positions which they need to buy their own cover for, they come to companies like us. We're based here in Bermuda. They come to us and we negotiate with them on selling insurance policies to insurance companies. So essentially, it's a way of creating capacity from an insurance company by buying their own protection on their portfolio business.
So you're effectively the insurer of the insurers.
That's right. Yes, and that's probably a terminology that's used quite often. That's probably the simplest way of thinking about it.
And for the man on the street, it's not a sector that's very much front and center, is it? People are used to dealing with insurance companies like Direct Line and those kind of consumer-facing businesses. This sector, although important, seems to very much, I wouldn't say live in the shadows, but it's not something that gets talked about a lot even in the retail investment press.
No, that's true. And I guess as a business to business wholesale, if like trade relationship, for that reason, it's less visible in the retail sector and the retail press. But in the same way that an insurance company will ask questions around the house they're insuring, the assets they're insuring, and that's a single risk. When we take on as a client an insurance company, we're asking questions around their entire portfolio of risks. So it could well be that an insurance company in the UK has a particular high concentration of risks in a certain county in the UK. They'll come to us and say, we have this portfolio of risks, which all in their own right, they're very happy with. But when you put them together, it's a larger number than they wish to have in their overall portfolio. So we inquire and we model and we ask them questions and model data around that portfolio of risks. And from there, we establish a price and a premium and what we believe is an adequate rate to charge to absorb some of that risk from them. So it's a similar process, but it's just done at a higher portfolio level than on an individual property by property basis.
So, for example, an insurance company might feel that it's taking on a concentration of risk in a specific area or a specific industry or indeed a specific risk itself, and they would come to you and say, can you take some of this off my table, so to speak?
Yes, that's right. And an example away from the property analogy that I've just drawn would be a risk such as an oil platform. Some of those are very high values around the world. We have a specialist unit here that can engage on taking on risks like that. And in some cases, the conversation will actually concentrate and focus down just on one or two very large risks, which the companies insuring those, for whatever reason, have an extended position, extended exposure, and will want to lay off some of that risk. It's very rare that we would do it and transact business for less than 12 months. So pretty much all of what we do, in the same way that you would buy your house insurance, is for 12 months and then it's renewed. What we do is, when we're talking to insurance companies about risks like that, we will contract with them for 12 months, take on that risk for 12 months. They pay us a premium. And then at the end of the 12 months, when that policy is due for renewal, we review it in the same way that your household will be reviewed. Look at the results, look at any claims that may have come through. Is the premium still adequate? Do we still like the wording that's being used? And so it's a similar 12-month cycle of business. So when we're writing risks into our own portfolio, essentially they last for 12 months, and then we renew that block or that portfolio of risks with the individual insurance companies.
And do you just deal with UK insurance companies, or all over the world?
No, one of the key tenets in setting up the business was, and this is fairly typical for reinsurers, is to create a geographical spread of business. So for us, we pretty much transact across the globe, but there are certain territories that we don't transact in. Large parts of the Eastern Bloc, or the former Soviet bloc, we don't transact in. Various reasons I can go into, but very often the quality of data is just not available in areas like that. Plus, obviously, you have sanctions exclusions as well. Parts of Latin America, again, a lot of the data that we are presented with is very often less than the level of granularity we require. So it forces you not to transact business in certain territories. But beyond that, certainly, we have a lot of business that we transact in the States, United States. The business that comes out of there is relatively easy to model and to price and to run data around. It's just the way that the data is established as a flow from there. But also out into the Far East, Asia Pacific, Japan. We transact business out there in the same way. The benchmark for us is the data adequate for us to get the level of granularity around it that we require? And if it is, then providing it's blending into our overall portfolio and we're not becoming imbalanced in any one territory or region or geography, then that's pretty much how we look at it. But being able to offer contracts where you're covering a multitude of regions, if you like, it produces an inherent balance in the portfolio rather than being concentrated in any one country or region.
And so you set up the company and decided to list it on the stock market. What was the reasoning behind that?
Yes, we well, Neil and I, that's Neil Eckert, the other co-founder. We've both been in the industry 40 years each, pretty much, and we've been involved in other companies, both in the public sphere. Both Neil and myself have been involved with other public companies. And when we started looking at this in sort of late 2019 into 2020, we were faced with the either going down to the private equity route or the IPO public listing. And we just, in the conversations we were having, we could see that there was a considerable appetite for a clean balance sheet on the public markets to be created. Number of investors that we were talking to made the comment that they could see that the market was changing, the cycle was changing and improving in reinsurers' favour, but there were relatively few ways to play in that space, particularly on the London market. And so when we started those conversations, it became apparent to us that even though it's a fairly long process to go through to deliver that IPO, it gave the company a very much sort of long, almost like a long only investor base that we knew was going to be a very stable structure for us to build the business off of. So it was the route that we went, and we're very pleased that we did. And the business, we raised those funds through the IPO process through 2020, and we went live in December of that year.
And from the perspective of an investor who might already have, they might already own shares in insurance companies, but these are like the traditional insurance companies. what other considerations are there from their perspective when they're looking at, say, a reinsurance stock as opposed to the insurance brands that a lot of people are already familiar with that they can buy on the stock market?
Well, I think probably the way that, when you look at the way our portfolio is structured, um, essentially the pattern of claims which we expect to pay broadly follows the insurance company's payouts, in that you write a policy for 12 months. If it's of a property nature, then the claims on those tend to be presented relatively early on. And then over the course of maybe a couple of years, the property policies will come to full fruition. Insurance companies write that business and they have the same kind of payout pattern. When it comes to liability business, so third party liability business, in the same way we write those portfolios, and claims there will tend to evolve over a period of maybe 3 to 4 to 5 years. So we follow a similar claims payout pattern to the original insurance companies. Where a reinsurance company will differ is in the exposure to larger one-off events. So you get more volatility around a reinsurance company's results because of the prevalence of things like earthquakes or large windstorms. So a reinsurance company will tend to, in very broad terms, have an exposure and more volatility around the results associated with natural perils events, earthquakes, windstorms, etc., which perhaps you won't see in some of the insurance companies, where perhaps they have a larger exposure to motor or household business in particular regions. So we, in building our portfolio, are very cognizant of that, and we run analyses and certainly cat management processes around exposure to things like Japanese earthquake or Californian earthquake or European flood. And they all form a part of our component portfolio, but we are very much committed to the premise that no one area, one territory can significantly imbalance or outweigh the portfolio. So it's a blend of smaller claims and larger claims in any insurance and reinsurance business. But I think probably the way that the investors just think about it is that there is probably more volatility around the reinsurance company results than there would be a typical insurance company.
And I presume your overheads are probably fairly small because it's not a labor intensive business. You don't need to have any plants or anything like that.
Well, that's true. We distribute through insurance brokers, pretty much solely through insurance brokers. So the business comes to us through a series of insurance brokers. Um, for us, in our 5-year business plan, we have forecast for us to be just under $1 billion of premium written by the time we get to our 5th year. That's annually. And very broadly in our IPO document, which we're sort of largely on track with, we estimate the costs of running the business at kind of that 6 to 7% of premium. So it's actually a pretty competitive model. We're based here in Bermuda, and as a reinsurance company, being able to operate the business with that level of operating expense, whilst your readers may not be familiar with some of the peer metrics for an insurance or reinsurance business, that's pretty much at the low end. But it means you can concentrate, your resources around the what we call, the day-to-day acceptance and underwriting of the business and claims payments. It leaves more in the system, if you like, to not just withstand the shocks that come from time to time, but also to more in the system to pay the claims as they evolve.
Also, when you're looking at the comparison between traditional insurers and reinsurance companies, are there any other advantages that the listed insurance company might offer from an investor's perspective?
I mentioned earlier, I think, around the kind of the cyclical nature of the industry, both insurance and reinsurance. And what we see is that terms and conditions and premium rates do move quite considerably in a short space of time. I think, as we've touched on, one of the aspects of us as a reinsurance business is it's very scalable in a relatively short space of time. So being able to access large portfolios of business in a rising market, and being able to do that in an efficient way with relatively low operating expense is a very good position to be when the market's changing. You can scale up in reinsurance, and by the same token, you can scale down, and that's not to be missed. That in tracking the underlying profitability of portfolios of business in different regions, in different countries, different classes, we can see patterns emerging where either classes become very attractive or become less attractive. And within reinsurance, in transacting larger blocks of business, you can scale that up and scale that down. And it gives you the ability to, I guess, optimize the performance of the business over several cycles. We're not having to set up distribution chains and sell thousands and thousands of policies at any one point in time, which invariably has a slower delivery to market. So for us, it's more immediate. And that's, I think, one of the key aspects of a reinsurance business, that you can scale up and scale down and optimize that market cycle.
So it means that you're lighter on your feet effectively versus a traditional insurer.
Yeah, yeah, very much. And providing you establish yourself in that way, which we've done here, I think, in one location, and we can allocate capital and allocate our capacity efficiently into those emerging areas of interest. And that's really what the business is about. And by the same token, monitor those. And as they start to cool off, you put your foot on the brake in certain areas when you need to. And so it's nimble is a good analogy.
I'm talking of shocks to the system. What was the impact like of the Russian invasion of Ukraine on the insurance market and more specifically on Conduit itself?
Yes, so there's been probably a heightened awareness in the general press of the Ukraine situation as it plays out in the insurance space. The losses arising out of Ukraine are broadly falling into two class definitions, if you like. One is the war and the physical damage to buildings, which there is some cover in the industry for that. That's given for damage to typically what would be either large factories or hotels and large commercial buildings. Some of those carry insurance for warlike acts. That's been kind of largely quantified, I think, in the industry, and they've got a good handle around that. The other aspect of the Ukraine situation is the aviation claims, which are being reported more and more in the press. And this is essentially where the aircraft that were either in Russia or in Ukraine at the time of the invasion, if you think of it in that way, were either confiscated or taken out of action by the various forces there, and those planes are insured on the world stage. Whether you define it as theft or destruction of the assets, there's an insurance discussion that's being had. There's a lot of uncertainty around which policies will respond and to what degree, and that will play out, I think, over the course of the next 18 months to 2 years in various legal forums. In terms of quantification, we have a relatively low exposure to aviation as a whole, and certainly that region. And for us, we have publicly stated that our position in the Ukraine is just under $25 million. So that's in insurance speak or reinsurance speak. That's the reserve that we've put on that, and we've put that reserve, and we're holding that as an expected ultimate claim that we will pay around Ukraine. So very broadly, it represents a manageable event for us. It was certainly for an event of that scale, a figure of $25 million was pretty much within the range of what we would expected. So even though it's a shock to the industry as a whole, I think for us it's become a manageable part of our our claims payments that we're expecting that are flowing through in our first couple of years.
And how do you think Conduit's now positioned coming out of 2022 and what was quite a turbulent year? I mean, how are you feeling now?
Well, I've been through many cycles in my 40 years in the industry, as has Neil, and it's very rare that you see a confluence of factors which are presented themselves now. A lot of capacity in the market withdrew, not just on the back of Ukraine, but certainly there were a number of large storm events, windstorm events, particularly in the US and some in Europe actually, in 21 and 22. Companies that had probably gone too long, had some extended positions in the catastrophe space, withdrew from the market, and it's left the playing field more open, shall we say, for new entrants like ourselves to come in and start to, if you like, I will say, take some benefit from the increasing rates that we're now seeing. So, as a business, for us, we have no back year legacy, so we're not having to manage a an incumbent book of business where either claims or IT systems are holding us back from previous years. So we have a clean balance sheet, and it's been a great position for us to be in now, really sort of growing into our skin. So the 5-year plan that we put together has come at a really good time, and where we're seeing now premium rates for us have certainly been significantly increasing. We've published some numbers about the level of increases that we've been seeing over the last 6 to 9 months. And there are a lot of classes that probably, in my experience, in the last 10 years, we probably would have struggled to entertain. And now the market has very much come into a bit more of a sweet spot there. And for us, we're feeling pretty good about life, particularly because, as I say, we haven't had to manage the portfolio down from having many years of legacy sitting on our system. So at the moment, it's a very good place to be. We're 55 staff here in Bermuda, and all pulling in the right direction. So we're looking forward, not backwards.
So effectively, what you're saying is you've had a number of participants in the reinsurance market have exited the market because various disasters have occurred. That means there's fewer of you taking those new risks on, and as a result, those policies are going up because there are fewer market participants.
Yes, spot on, and it's supply and demand. Whichever sort of aspect of economics you're looking at, that's exactly what it is. There's an increasing demand for our product from the insurance companies. One of the aspects that's driving up the demand for what we're selling is inflation. So the cost of the index linking, if you think of your house insurance, that's index linked, and that's not going up at 1 or 2% now. It's going up at 3s and 4s and 5s and beyond. So it means the insurance companies are having to put bigger limits out there. They need to buy more reinsurance. So that's increasing the demand for the product. And at the same time, the capacity, the supply has withdrawn, has reduced. So that's the dynamic that's at play. And it's across a number of classes now, not just aviation and property, but the way that the reinsurance industry works. It works in broad cycles, and it's very much it's a confluence of factors, as I said, that's just come together at this point in time.
And the final thing I wanted to ask you about is obviously things like natural disasters, storms, earthquakes. Those we're gonna have to live with, and it's fairly predictable that they're going to spring up from time to time. What is the reinsurance sector doing now that we've got things like, for example, the Russian invasion of Ukraine? There's a lot of worry around a possible Chinese effort to invade Taiwan. And then on top of that, climate risks as well, which are playing a bigger role than they perhaps did in the insurance sector, say 15, 20 years ago. What's the industry doing to manage those kind of risks? Because some of them are relatively new, and others are old risks that we thought we'd seen the back of, but seem to have come back in again.
Yeah, no, that's a good point. Um, from a climate standpoint, that's been an evolving factor in my experience, certainly for the last 5 to 10 years. If you look at the way that um, climate frequency and those losses have been occurring and reoccurring, it's been an emerging pattern. Certainly, the large storms and the large events certainly make the news, and your readers will certainly be aware of them. But for everyone that if you like makes the mainstream press as a headline, there's another 8, 9, 10 of them which are ticking through in the course of the year. And the data sets that we see and the way that we price business, there's been an emerging pattern that's been going on for certainly I think sort of the last 5 to 10 years. So the way that companies should be managing their portfolio is in that context. And certainly when we look at catastrophe business, we're happy to play in that space, happy to put capacity into those regions. But as one of my bosses used to say, you don't bet the ranch. You do it in the context of what you can afford to lose and withstand, given the portfolio that you have in place. So we certainly are very comfortable continue to write and analyze and write climate exposed business, but you have to do it in the context of the emerging frequency, and that's essentially what we price for and how we manage the portfolio. When it comes to events, kind of the more sporadic, such as the Ukraine type of event, the industry has exclusions at its disposal, and what you've seen post Ukraine is very much a realization that wordings and exclusions and clauses should be used and are being used now more frequently by reinsurers to exclude those types of perils. So there's always an element of bolting the door after the horse has bolted, as it were. But the language that's in place does give me certainly now a lot more comfort than probably would have done 2 or 3 years ago. The industry is in a better position to mitigate those losses through use of policy language. So it's a combination of two. You have to be aware of the emerging patterns and frequency on things like climate, but there's also a degree of exclusionary language that you can use as a defensive measure.
Well, thank you very much indeed for coming on the podcast this afternoon. That's been really informative, and we'll look forward to hearing more about Conduit in the course of the year.
Thanks very much for your time, and hopefully it's a bit of a window on the world of reinsurance for the readers.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news and sign up to our free newsletter there.